of the market. Thank you, Ed.
Thanks very much, Billy, and thanks to everyone for coming this afternoon, particularly when the cricket's just getting interesting. So the term emerging markets was first coined as far back as 1981, but it took a while for investable representative benchmarks to be created. So the MSCI benchmark, the most widely followed one, had its 35th anniversary at the end of last year. So it's an appropriate sort of moment to sort of take stock, really, of the first 3.5 decades of emerging markets. And the sort of the bottom line conclusion is, over that time, the asset class generated a 9.5% annualized dollar return. That did beat the overall developed world by a couple of percentage points, albeit the developed world was somewhat hamstrung by Japan, and emerging markets fell short of what Wall Street managed to achieve over that same time period. But really, that's not the main sort of take-home conclusion. The most dominant characteristic of emerging markets is the wild swings that have characterized it over that time. In fact, I like to think of emerging markets as a biblical asset class. You get these very prolonged periods of feast and then famine and then feast again. And interestingly, attempts to create synthetic indices further back in time, using the same kind of decision rules as to what would define an emerging market country at any point in time, you get similar volatility and swings. So, for example, the 1970s were a very good decade for emerging market-like assets. But then, although this chart doesn't quite pick it up, the early 1980s are very nasty in Latin America. Further back in time, for instance, the 1930s was a period in which emerging markets significantly outperformed developed markets. But then the 1940s, unfortunately, a couple of them lost wars or overthrew capitalism. And in fact, if you go right the way back into the 19th century, you see this same characteristic of decades in which global capital piled into the more peripheral parts of the world economy, typically financing infrastructure, railways, and so forth. The odd crisis, Barings, 1890, for example, followed by prolonged busts and no one wanting to touch the asset class for a while. So it does seem that pronounced swings in relative performance are a sort of enduring characteristic of the more peripheral parts of the world economy. And obviously, getting those swings right is crucial. So what drives them, and in particular, what's been driving the more recent swings? Well, the first is obviously China. So the boom that emerging markets experienced in the 2000s was very much associated with an acceleration in the rate of growth in China. China joined the WTO in 2001. And there was a significant increase in its exports in the subsequent years. And there was also quite a long-lived sort of secular property replacement cycle in China as cities completely sort of re-engineered their housing stocks, took housing from the center of the city, built suburbs, created central business districts, and so forth. And that added extra momentum to growth. But then from about 2010, after that sort of last hurrah, very much induced by credit, there's been a structural slowing of China's growth. Exports have slowed markedly. Most of the gains of joining the WTO have now been achieved. China hit what's called the Lewis tipping point, where surplus rural labor that was being transferred into the manufacturing sector began to run dry. The working population, in fact, is now shrinking in China. And then there's also a significant prolonged overhang from the credit surge that came in 2010. And in many respects, both the original acceleration of Chinese growth and then the deceleration of Chinese growth sort of caught people by surprise, creating long-lasting, initially upturns in demand and then similarly downturns. So the commodity sector is a good illustration of that. If we go back 20 years, in the early 2000s, relatively low levels of investment in the commodity sector. No one's really interested at that time. It's only a couple of years since everyone was obsessed by all things .com. China starts to accelerate, and that obviously creates shortages of demand, which only with a delay gradually induces an investment response. So 5-10 years of sort of positive investment, positive profits growth, rising return on capital, very positive for Chinese beneficiaries of Chinese growth, whether they're explicitly resources or just more broadly emerging markets. But then unfortunately, CapEx is hitting sort of new highs just as China starts to slow, and everything goes into reverse for 10 years or so. So sort of long-lived investment cycles allied to China, I think, is one of the factors that was influencing emerging markets' relative performance in the last 20 years. For what it's worth, our view is very much that China's structural growth slowdown continues from here, even though most of the reduction has already happened. But you can say, I think now, that a lot of people playing into China have had a long time to prepare for that. You see that with the relatively subdued levels of commodities capex. And certainly when you come to think about, say, base metals, maybe they're underinvesting relative to the next demand story there, vis-a-vis greening the world economy. The second factor that's been driving the swings in emerging markets over time is flows of hot money, flows of speculative capital. If we go back to 2010, when emerging markets peaked out relative to global equities, there was a significant amount of hot money flowing into EM. I've captured this by looking at flows into equity markets, flows into fixed income markets, but also things like international borrowing from banks, cross-border banking flows and so forth. So that was on a sort of 3-year cumulative basis. That was about 4% of GDP at its highs in 2011. And it's never a good idea to build up a wall of hot money, because hot money can leave very quickly at the first signs of trouble. So what EM had been doing in the sort of 2010s, 2011s was exactly what it had been doing in the 1990s, sucking in hot capital, leaving itself more vulnerable to subsequent downturns. And in part, these inflows reflected excitement and euphoria towards emerging markets. There was a kind of push effect from the developed world, but there was also a very strong pull effect. Emerging markets themselves were running large current account deficits, were in need of financing to fund those deficits. In 2010, 2011, people talked about the fragile 5 economies in emerging markets, countries like Turkey and India and Indonesia, all running large current account deficits. A number of emerging market countries were running red-hot credit booms: East Europe, Russia, Turkey, Brazil. And so you essentially were at a point in the cycle when EM was very vulnerable macroeconomically. It was unbalanced and required a prolonged healing process, hiking interest rates, devaluing exchange rates, corporate sectors having to delever their balance sheets, banking systems having to clean up their asset quality problems. Where we are today is very different. In fact, where we are today is very similar to the early 2000s. At the margin, hot money's actually continued to leave emerging markets over the last few years, in partly due to lack of enthusiasm, but also emerging markets hasn't needed the money. You've had much healthier external balances. Now, the slowdown in China, allied to the necessary macro adjustment that other countries had to undergo in the last 10 or 12 years, had a big impact on profit margins. So the blue line here is the emerging markets forward-looking profit margin. And you can see falls markedly over the first half of the 2010s and has sort of struggled to recover ever since. So this is excess capacity in the resource sector. This is banks seeing slowing credit growth and having higher provisioning. This is cyclical companies with fixed costs seeing slower growth and therefore seeing their profit margins being compressed. And the big problem for emerging markets' relative performance was at exactly the same time there's an almost once-in-a-generation rise in US profit margins. And in fact, if we go back through history, the worst thing that can happen to the periphery of the world economy is that the return on capital in the core of the world economy rises for some reason, so that all the capital is kept at home rather than venturing further afield. So amazingly, it's almost hard to imagine now, before 2008, EM and the US had the same profit margins, and now there's an immense divergence. And the prolonged underperformance of the last 10 years or so has created obvious valuation anomalies or divergences. So if we look at the forward P ratio, just the 12-month forward P ratio, emerging markets are on about 12 times and the US is on about 18 times. So that's a 1/3 discount. But if you then try to cyclically adjust earnings to allow for this divergence in profit margins and look at a kind of sort of Shiller cyclically adjusted PE ratio, you get something like this. So the blue line is emerging markets at 10.7 times, and the US, given those high profit margins versus history, is much higher still at almost 25 times. So that's a discount of roughly 55%, which in the relatively short history that we've got is the largest that we've seen. And when you look at people who try to make long-term asset return forecasts, 5, 10-year forecasts, they very often put emerging market equities quite high up on the pecking order of prospective returns. And that's really what they're picking up on. That not only are emerging market assets relatively cheap, but their margins are also relatively depressed versus historic experience. In other words, emerging markets are priced to be moribund going forwards. We know that China is going to continue slowing, but at least everyone's had plenty of time to be prepared for that now. And what's certainly the case is that macro balances are in much better shape than they were. Whereas the US is arguably still priced for a fair amount of perfection, and woe betide if wage inflation stays structurally high, or interest rates stay structurally high compared to the last 10 years, or if the investment boom that the government's trying to induce creates capacity overhangs, or if indeed regulation turns more activist. And then the third factor that's driven many of the recent swings in emerging markets is the dollar. The red line here is the trade-weighted dollar. The blue line is emerging markets versus global equities. And at least since the mid-1990s, there's an inverse relationship between the two. Commodities are obviously priced in dollars. Many emerging market countries are commodity exporters. At the same time, when the dollar's strong, that tends to put pressure on emerging market currencies, forces central banks to raise interest rates, curbs domestic growth potential. And importantly, the dollar now looks quite expensive when you correct for inflation differentials. So this is the real exchange rate. The blue line is a broad set of trading partners for America. The red line is just its core trading partners. And both are well towards the top end of the range. Importantly also, this chart is mean reverting. Extreme readings tend to begat a phase in which the real exchange rate goes back towards the mean. In fact, more than that, nearly always it goes through the mean and goes right to the opposite end of the extreme. So there is a characteristic to the US dollar since the collapse of Bretton Woods, which is decade-long swings from expensive to cheap to expensive to cheap again, which sounds an awful lot like what emerging markets' relative performance has been doing over the same time. So the relative underperformance that began around about 2010, 2011 in the EM coincides with the dollar being unusually cheap versus both core and a broader set of economies. And pretty much the last 10 to 15 years has been a sustained re-rating of the US real exchange rate. However, the starting point we're at today suggests that if you take a longer term view, 5 to 10 years, the overwhelming balance of probability is that the real exchange rate starts to weaken again. And that actually what has been a headwind for EM and for commodities turns into a tailwind. So as perhaps investors start to take a fresh look at emerging markets, the question that they're always going to ask is, so where's the growth? Because the potential for stronger growth has always been integral to the marketing pitch for emerging markets. Well, first, I think we need to be clear about what growth we mean. We are dollar-based investors, or at least hard currency-based investors. And so to be honest with you, it's not much help if a country grows 7% real GDP and its currency collapses. So it's dollar GDP growth that I think that matters. And this chart here sets out our 10-year expectations or assumptions when it comes to dollar GDP growth potential. So first of all, the US is on the far right-hand side, not because I'm particularly bearish about its real GDP growth. I'm assuming essentially a sort of 4 or 5% nominal GDP, but because everyone else in the world, I think, benefits from a secularly weakening real exchange rate of the dollar. So every other country gets a bit of a positive real exchange rate effect to add to their inflation and real GDP growth. It's also not China, which is actually slightly to the right of the middle of this pack. So as I said earlier, I think China continues to slow structurally from here. And in addition, when I think about exchange rates that I might want to hold vis-a-vis the dollar, it wouldn't be the renminbi, which I don't see as being particularly attractively valued and I think is propped up by capital controls. Instead, if we cast our eye at the left-hand side of the chart, the really interesting opportunities stem from, I think, either countries with a low starting point, as far as income levels are concerned, and reasonable macro policies and a reasonable microeconomic outlook. And so Southeast Asian countries jump out as being obvious candidates in that regard. Or it's countries that can benefit from convergence potential. So they're integrating with a richer neighbour and experiencing sort of like a sustained catch-up opportunity. The former communist countries of the European Union would be a good example of that. They're obviously growing faster than the EU pretty much every year, and incidentally, by about 2040, on average, those communist countries will have the same living standards as the southern part of the European Union. And perhaps also, after not really making the most of NAFTA for the last 20 years, Mexico might be able to grow a bit stronger in the next 10 years if this concept of friend-shoring and diversifying supply chains away from China takes hold. But, I hear you ask, does dollar GDP growth actually translate into equity returns? Well, there's no doubt that a lot is lost along the way. The stock market isn't necessarily going to offer you the most exciting dynamic parts of an economy. Often top-line growth is sacrificed through weaker margins. And growth requires capex, and there's no guarantee that capex is shareholder value accretive. Nevertheless, this chart does show that in general, over the last 20 years, within the emerging markets, those countries that have generated stronger dollar GDP growth have also generated stronger dollar equity returns, with one notable exception, an outlier there on the right-hand side, which I'll come on to a little bit later. But in general, it's not a reasonable exercise to say, okay, where's the growth? And now can we find any investment opportunities in those areas? And one place that we do think there's an investment opportunity to play this growth opportunity is in banks. If I go back to the early 1990s, when I first got interested in emerging markets, one of the great investment themes was that there was broad-based potential for rising credit to GDP, increased financial sophistication, credit deepening as these countries developed and their financial markets developed with them. Well, to be honest with you, that story has played out in a number of emerging market countries now. This is bank credit as a share of GDP. In Korea, or in Taiwan, or in Thailand, or in China, or in Malaysia, or Chile, or indeed even in Brazil, you've now got credit to GDP ratios that I don't think you can say are ridiculously low, and the potential for there being secular expansion in their credit penetration is relatively muted. But there are still some countries where this plain vanilla classic emerging market story has yet to play out, and some of them overlap with where those high growth rates are to be found. So for example, Indonesia is the third to the left of this chart, with only about 35% bank credit to GDP, and the household sector very lightly levered. And Indonesian banks, we think, are one of the more interesting medium-term investment opportunities in emerging markets. We've got roughly 10% of our portfolio invested in this area. High return on equity banks able to self-fund their loan growth. And India, although the corporate sector has levered up a bit, the household sector still looks relatively lightly levered. And private sector banks in India, we think, are again an attractive long-term investment opportunity. We again have roughly 10% of our portfolio invested there, the largest holding in our portfolio, as it has been for many years, being HDFC Bank. And potentially second to the left, Mexico also has relatively low credit to GDP, and we own a bank there, Banorte, which we think can benefit from the opportunities. So domestic investment opportunities in countries with the capacity to grow fairly rapidly represent what we think as the secular investment opportunity in emerging markets. Now, the domestic growth stories in markets like Korea and Taiwan are substantially less interesting in comparison. I mean, really, these are effectively developed countries that are still classified as emerging for various reasons to do with political risk, maturity of their financial sectors, and so forth. They are much more export-driven economies and stock markets, as this chart illustrates. So the red line here is the Korean stock market, and the blue line is Korean export growth. Effectively, these two cycles are very closely correlated. Equities tend to lead, as this chart shows. That said, they have rallied very, very hard since the third quarter of last year, even as world trade continues to be very sluggish. And so this is Korea, and if I replace this with Taiwan, I'd effectively get the same chart. So North Asia in EM is essentially a kind of sort of export-driven story. And as I say, it's performed very well in the last few months, which reflects their status as sort of plays on early cycle recovery in the global economy. It's the first thing people buy when they turn more optimistic about global growth. And this chart here shows that after a notable deterioration in growth sentiment in 2021 and the first half of 2022, a period in which Korea and Taiwan struggled, there was a notable bounce in growth expectations starting the third quarter of last year that helped Korea and Taiwan to rally fairly strongly. Europe did not have a cold winter and therefore did not have a gas rationing crunch. China unexpectedly reopened and supply chains were gradually sort of resolved and put back in place. And the US has, at least so far, yet to have the recession that was widely expected. So there's been a big improvement in global growth expectations until just recently. There are the first signs that actually sentiment is starting to roll back over again. Global macro surprise indices show that data is starting to disappoint rather than surprise more often. And that perhaps raises the possibility that actually the world economy is not in the early stages of an economic recovery right now. It's still rooted in a downturn. And to be honest with you, that's certainly been our view. The indicators that we track suggest that there's still some more downside risk, not to mention in a few countries recession risk, before we get a proper bottoming out of global growth expectations. If all that's right, then you might get one last hurrah in the dollar as a sort of risk aversion beneficiary before you finally get that peaking out in the secular story, and possibly some short-term downside risks for more cyclical assets as world trade perhaps takes a little longer to revive than has lately been assumed. And now I need to come to the outlier in that earlier chart that showed growth and equity returns. And unfortunately, it's a big outlier, namely China. If we go back to 1994, since then, Chinese dollar GDP per capita has risen by a factor of 25. If you had known that at the time, you would have surely put all of your life savings in China. And if you'd have bought the MSCI China index, which you couldn't, but in theory if you had, you would effectively be down 6% over that entire time period. There is a stunning disconnect in the long term between China's remarkable economic development and the performance of its stock market. So the obvious question is, why? Well, to some extent, it's all those things that generally make equities an imperfect proxy for growth, the factors that I mentioned earlier. But I think there are also some China-specific factors. This is a stock market with unusually high levels of state ownership, and state-owned companies obviously have a range of objectives, not all of which relate to profits. Even if you're in the private sector, this is a country where the government interferes with you perhaps more regularly or more inconsistently than in many other countries, as any private education company in China would tell you. In addition, this is a slightly more subtle point, I actually think that a country run by the Communist Party is more competitive in many of its industries than much of the global economy, including the US. If you have a great idea, if you make some supernormal profits in China, someone comes along and copies that idea, either legitimately or illegitimately, sooner rather than later. Amazon continues to dominate American e-commerce. Alibaba's grip of Chinese e-commerce has been slipping for the last 4 or 5 years. In many respects, China resembles the economists' vision of perfect competition, where supernormal profits never last for long, much more than many of the what we would label capitalist economies in the world economy. And to digress slightly, I actually think that the best investment opportunity in emerging markets is a country with lots of growth potential, but that is not quite capitalizing on that potential to the maximum. It has inefficiencies, it has bureaucracy, it has imperfections, which means it doesn't grow quite so much. But on the other hand, it means companies can create moats from which sustainable profits can be created. And as an equity investor, actually, I'm more interested in that. Anyway, going back to China, obviously we've seen a marked bear market since 2020. The stock market's derated from 20 times earnings to now more like 9 times earnings. They scrapped zero COVID late last year. We had a big bounce. But then just lately, as this blue line shows, there's been quite a notable relapse. So what next and what do we think about China? So firstly, our view from the start has been and continues to be that property, which has had this great downturn in the last 2 to 3 years, is not coming back. And that's part of the reason why growth is going to continue to slow structurally. Demographics are turning negative. They've overbuilt property. The whole pre-sales model is under a cloud. There's the threat that property tax will be introduced sooner rather than later. And ultimately, policymakers don't want property to come back. They want homes to be lived in, not to be a source of speculation. There was a bit of a bounce in property in February, March, and then there was a notable relapse in April. And based on the broader market reaction in China, it seems like many people were anticipating a classic property investment-led upturn in China. If they were, no wonder they've been disappointed. I think it will be necessary for there to be more policy easing over the next 2 to 3 months. Sentiment in the real estate sector is so depressed at the moment that it feels like it needs further support. But all I think we should be really looking for in China is an L-shaped recovery in the real estate sector. This is not going to be an archetypal Chinese recovery. Instead, what I'm looking for is a continuation of the improvement in population mobility, and therefore a revival in contact-based consumer activities and business activities. This chart here shows you passenger mobility is now self-evidently recovering now that zero COVID's been scrapped. And before COVID, the service sector in China was adding roughly 8 million jobs a year. And in the last 3 years, it's fallen way short of that. In fact, last year, the service sector cut a lot of jobs. So it's estimated that relative to the pre-COVID trend, we're about 20 million jobs short in contact-based services. And that's where I think that the recovery potential it exists in the next 2 to 3 years. With every month of normality, with every month of people being back out and about, spending in restaurants and travel and tourism and leisure and so forth, I think we'll gradually see an improvement in job creation in the service sector. And that's where I think the potential for a recovery is to be found. So for us, the investment opportunity is in sectors like restaurants, beverages, travel, consumer-focused, services-focused. So summing up, many of the factors that have held emerging markets back in recent years, I would argue, are either no longer present or are likely to reverse soon, or at least are well understood and now priced for. The main near-term headwind that I see is that the global economy still appears to be slowing, and that has implications for the more export-oriented parts of EM. China looks cheap and unloved, and whilst there are maybe good long-term reasons for that, that does look a bit overdone in the short term, but with a focus on opportunities, I think, in the consumer sector. And finally, the sheer size of China in the overall emerging markets universe is frankly a bit unhelpful because it obscures the areas where structural growth is still to be found, most notably, I would argue, in Southeast Asia. Thank you.
Thank you very much, Ed. Next up, we've got Robin Parbrook. He's the manager